Hello, all. It's Thanksgiving week now. Excuse me. And this is episode 6 of the Real Estate Show. And I just wanted to shoot a quick episode because another piece of pushback I'm getting a lot just in the last week or so is that the Fed's going to keep dropping the federal funds rate, and therefore rates will come down. Well, no, that's not actually true. The federal funds rate does not control the 10-year treasury bond, that's where the rate is set for. It's not set with a straight formula. It's a qualitative analysis from mortgage originators, and then factoring in what Fannie and Freddie, the terms and conditions of the mortgages that they will buy, because they buy most of them in securitized pools. But the rate coming down on the 30-year loan, or on all loans really, the other ones are based on the 30-year fixed rate with 0 points. All those are set with the 10-year Treasury bond. Now, the 10-year Treasury bond does not, the yield does not go down on the 10-year Treasury bond unless major investors, I'm talking about professionals, not individual retail investors, are buying a lot of the Treasury bond. That's when the yield comes down. You got the one thing you have to remember, and people forget all the time, and it's kind of like it leads them astray, is that when people chase, when they go into an investment, in the case of a bond, the price of the bond goes up, but the yield comes down, the interest rate on the bond effective to the new buyer, because the new buyer's bidding up the price, and the income coming from the bond is staying the same. So it's a smaller percentage of that of their purchase price, the payments being made on the bond. That's why the yield goes down when the price goes up. And people they have trouble wrapping their head around that. It takes a while to get comfortable with it, but get comfortable with it, because that's what causes the 10-year Treasury bond to yield to come down, and therefore mortgage rates to come down. That has to happen, and I don't see a lot of factors that are going to cause that to happen, and I don't think anybody else does either, unless we have major pain in the economy. Then investors, especially institutional investors, the big ones that are moving hundreds of billions of dollars around, will have what they say is that there'll be a flight to safety. And what that means is selling equities and stocks and buying treasury bonds. And the U.S. Treasury bond is considered the risk-free rate. It's the safest, which is a bad word in investing and finance, but it's not risk-free really, because you still have risk from rates going further down, and if you have to sell those bonds, they're worth even less. So, anyways, actually, I messed up that inversion. See, it's easy to do. If the rates keep going down, your bonds that you bought at a better yield actually go up in price. So you can do well if you catch it as it starts going down. So, anyways, think about that. Let's reiterate again, when these investors rush into treasury bonds in general, they don't just rush into the 10-year. They rush into the 2-year, the 5-year, all of them, 20-year, 30-year, depending on how their forecasts look for the economy and the investment markets. But that causes all of the prices to go up, and they go up at a little bit different rates, but they all track together. And the yield, or the interest rate that gets paid out to the owners of those, the new owners of those bonds, is the same as it was before they bought them. So it's actually lower. It's a lower return on investment to that new buyer, and that's the relationship. That's the way it works. So you got to get your head around that to make this all make sense. So if that happens and it goes down quickly, the mortgage rate, because yields are going down on the 10-year Treasury, that means there's some really bad stuff happening in the economy, and that's also going to affect the housing market negatively. Now, people will say, well, maybe they just stop pricing based on the 10-year. Well, they really can't. It's a risk based calculation, and it's always priced that way. The reason it's priced on the 10-year is because it's the closest to the average duration, meaning how fast people retire their home loans. And the average has been for a generation, at least a generation now, 7 years, that people either sell or buy, they sell their house, pay off the mortgage, or they refi the mortgage. The average of that, or they pay it off. That's a very small part of what goes into the average. The average for all of those activities is 7 years, and that's why they use the 10-year Treasury bond as the primary pricing vehicle for interest rates on homes. Okay, so this is just a really important concept. You kind of stack all these concepts together that I've been talking about in this episode and in the prior episodes to understand why the housing market is going to likely correct down a significant amount one way or the other. If the investment markets get really rough and big investors start running for cover, yeah, rates will come down. But that means that people won't have any money, especially at these ridiculously high prices. And then one thing that's completely different in this cycle from the past, and I'm going to repeat this over and over again, is that people don't have the money. The prices are higher than they've ever been, even adjusted for inflation. They're double what they were 20 years ago. And wages have not gone up anywhere near that amount. So people can't afford it. Plus the price of everything else that you buy is double what it was 3 or 4 years ago. All of your groceries, your utilities have probably gone up by at least 30%. Your property taxes have gone up. Likely your insurance has gone up. Depending on if you live somewhere where there's no natural disasters, you probably haven't seen insurance get as bad. But insurance companies are raising insurance prices across the country, even in low-risk markets, just to make up for their high-risk markets. Anyways, I don't buy into the grand conspiracy that all these institutions are trying to necessarily screw the little guy. But you got to remember, in this country, and this is a problem with the way our system's set up, the only responsibility of these companies is to maximize shareholder value, not your value. There's no social component to capitalism in the United States. And that's where I think we got it wrong. There's some companies like Patagonia that have a social component, and they have it in their mission statement that they can actually do things that are good for society. But that's unusual, unfortunately. So that's about enough for right now, because I don't want to get all crazy into details. I'd really like to get some feedback from people so that I know what you want to hear more about or what's not making sense about this stuff. It took me a long time to get this. It doesn't just make sense, especially the yield thing. When you first hear that price and yield goes in opposite directions with bonds, it doesn't make sense, and to most people, but it does once somebody explains it to you. So hope you're all having a great November week in 2024, and have a great Thanksgiving wherever you are. Try to at least check out for a little bit and don't stress. Talk to you soon.